Joining me now is Mike Wilson, Morgan Stanley's Chief U.S. Equity Strategist and CIO. Mike, great to have you with me here. It's a fascinating round trip we've had, right, since early, I guess since February in a sense. Where does the market sit in your mind relative to all the kind of important drivers, right? I mean, we had this tariff policy scare and then a little bit of relief off of that. But in terms of the fundamental picture, technicals, demand for stocks, and all the rest of it.
Yeah, good afternoon, Mike. I would say, I mean, the tariff scare was sort of the final piece of what had been a correction that started almost a year ago. I think you've had some guests on today even talking about, like semiconductors, for example. I mean, they had a horrible second half of the year, as did many other groups. And I always like to say that markets sort of bottom on bad news. They also top on good news. And we basically had a lot of bad news through the end of last year and the first quarter that people didn't acknowledge. Most notably, just all the policy headwinds we had on immigration enforcement. We had DOGE, which was supposed to cut a bunch of spending, not very growth positive, and of course tariffs. We also had, AI CapEx deceleration and the DeepSeek announcement. So we just combined a lot of information into a short period of time, and the Fed, of course, has been on hold. And I kind of view Liberation Day more as capitulation day. And we sort of cleaned out a lot of things. Now, throw on top of all of that, the sequencing of the policy going kind of growth negative, and now we're looking at some of the growth positive policy changes. For example, the tax incentives in this bill, deregulation, some of the things we're talking about doing with capital controls. That's what we have to look forward to, and that's what the market has gotten ahead of. And the one variable, I think, as you know, Mike, we've talked about this many times, the most important variable for stocks is earnings, and most importantly, earnings revision and earnings revision breadth. And if you looked at a chart of earnings revision breadth, which we published in today's note, it's a V-shaped recovery, and it's powerful as we've seen since COVID. So the expectations just got too low, and so it's not irrational at all for stocks to also show a V-shaped recovery here since April.
Yeah, in fact, we're showing that chart right now, and it is pretty stark. Also, though, I would note that it was a pretty similar trajectory, into the spring of 2023. We're up at about the same level. We bottomed around the same point in terms of earnings revision breadth. What's different now versus then when I think you weren't so pleased with the risk reward for stocks?
Well, back in 2023, what I would say the difference then was it was extremely narrow. Now, it's still a little bit narrow, but nothing like 2023. 2023 was coming off of what was a very sharp earnings recession in 22, particularly in technology shares and some of the consumer names payback from COVID. And the Fed, they were still sort of in hike mode. They weren't even close to thinking about cutting rates. So that's different this time. We think this is going to be a broader recovery. We've gone through a massive, so I would call rolling recession. And I think with the Fed cutting in the second half of this year or next year, we could see a rolling recovery because now there's quite a bit of pent-up demand, particularly in those interest rate sensitive parts of the market.
So where are we rolling into next, I guess, is the question. I mean, you could sort of observe just from a top-down level, okay, we're back up to 22 times forward earnings and the S&P 500. Obviously, you can slice and dice it and come up with something lower for the typical stock. But in terms of this technology, large cap growth bias that the market has had for a while, is that changing? Are we finally going to broaden out?
I think we're going to see those stocks continue to do well. They have tremendous earnings power. But what can broaden out is financials, some of the industrial space, which I think Chris was talking about earlier in the show, and then even some of the mid and small cap companies once the Fed starts cutting interest rates. Well, I'll go back again to interest rate sensitive parts of the market. I could name 6 or 7 different areas that have been in a recession for the most part for the last 2 years, whether it's manufacturing, housing related, autos, consumer goods, and all of those are very interest rate sensitive. So I think those parts of the economy is what we're looking forward to for 2026. And then, of course, AI, right? So AI, we spent all the money on CapEx, but now what we have to look forward to is the application layer. That's why a lot of these software stocks are doing better. And sort of the diffusion of that technology into the broader economy. I think that's what the market is getting excited about now. That's why multiples are high. They're saying the earnings power potentially could be higher than anybody's expecting next year because of margin expansion from AI efficiencies. And I think that's something to think about as the market broadens out next year.
In order for all those positive factors to really take hold, what do you have to assume about where the tariff rates and kind of the breadth of the tariff protection settle out?
Yeah, I mean, we've had a view for quite a while. We've always viewed this as sort of a an import tax, a VAT tax, a consumption tax. And I think what they're driving towards is sort of a 10% VAT is essentially the way I think about it. It's a consumption tax, and it's a tax, okay, no doubt about it. But it's shared amongst importers, exporters, and consumers. Consumers will not eat all of that, and I don't think there's a ton of pricing power. But if we can kind of get to that point sooner rather than later, the market will look forward because companies can mitigate that. Companies can manage that. What they can't manage is the back and forth, 30, 40, 50% tariffs, and then how am I going to get my supply chains reordered? But if we can kind of settle on that 10% number, which is a big revenue generator, by the way, that's $300 to $400 billion a year, that's a good place. And I think there's a decent chance by the second half of the year we could get there.